I set myself a goal for $5,000 a month. I reached that target, so I'm projected currently to make $5,337 a month now. I don't give a crap what anybody thinks of me anymore. I'm completely debt-free now. I've wiped out all the debt I've had. My credit score went from 631 to 831. I don't need the cash flow right now, but this is fun for me. It's working. Put some money into an investment with the expectation of generating a return. I set a dividend milestone in Div Tracker or Stock Events or Blossom. I make a couple reinvestments whenever my distributions come in. It's like, bam, 25,000, bam, 50,000, bam, 85,000, bam.
Welcome back to another go-round worth of Masters of the Market. Joining me this week, we have Jamie, the Rabid Mongoose Financial. It is quite a story to tell. Jamie has a portfolio of over $100,000, making quite a hefty sum in dividends, almost $100,000 coming up at the end of the year. But here to tell that story is Jamie himself. So Jamie, welcome to Masters of the Market. I want to go ahead and just ask you the first question, which is, what exactly is your story? How'd you get to where you are today?
How my story started. Life doesn't always turn out how you expect it to be. I bought my first house when I was 23 years old. I got a well-paying job. I was fortunate enough to get a well-paying job early on in life. I traveled back and forth from my hometown in Cornwall, Ontario to Hamilton. I worked in Hamilton, Ontario for about 10 years. Basically, with the amount of debt I was in, I was on the verge of losing everything anyway. So what the heck if I lose another 15 grand trying something I've never tried before?
So Jamie, let me ask you this. Why not go, into growth stocks? Why passive income stocks? Why passive income ETFs? And of course, we all get it. You make income from these products, from these ETFs, but growth has the opportunity to deliver in quite a hefty sum as well. So why not growth to start?
Well, basically, it was a time crunch. I needed to clear up this debt. My mortgage is up for renewal in March of this year. My mortgage broker told me they're not going to renew you, buddy, with this much debt. Like, come on, man. What are you doing? So I had to come up with a plan. I got myself into that hole, and I'm not going to take the easy way out of declaring bankruptcy or doing a consumer proposal. Whatever it takes, I'm going to get myself out of it. I didn't have the time to do the growth route. It was scary. I'll have to admit. It was a chance. Like, all of this stuff was new back then, and it was unheard of. Yields like this are, like, it's crazy.
Do you think that this is kind of a new era of quote-unquote dividend investing, through distribution rates, as opposed to the more traditional dividend investment journey where you're investing in, whether it was the Visa, the Verizons and AT&Ts for the yields, or the Visas and kind of United Healths for the lower yields but more dividend growth? Are we at a moment in time where we're like pushing a lot of those stocks to the side to invest into these ETFs? And is this the future?
It certainly feels like it, at the rate things are going now. They're launching these things like every week a new one comes out. It's crazy. Like, I never would have imagined that it would have worked out the way it has, and I'm grateful that it has.
What do you typically look for? Because I mean, the reality is, just like you said, they're rolling out these new ETF products weekly. And investors are getting almost flooded with options in terms of what to invest in. So what do you typically look for when it comes to picking the right income yielding ETF?
I was always a yield chaser. So the first thing I look at naturally is yield. I also have a tough time making decisions. So I would typically buy every single one that came out. I'd buy one share on launch day, watch it for a couple distributions, and then eventually I had a portfolio with like 111 holdings, and it wasn't as capital efficient as it should be. And then I started joining high yield groups on Facebook and Reddit, and I found a formula that I recently started using. Couple months back, I did my flat squirrel transformation post where I sold half of my holdings, and now I'm down to 52. So basically what you do there is you take the distribution amount and you divide it by your average share price, and that'll tell you how much of your capital will be returned to you via that distribution. It's data that's right in front of your eyes. You know exactly on Wednesday what you're going to get paid Friday. So, for example, this week I offloaded my PLTY because the last two distributions were disappointing, in my opinion, to go from a $7 one to a $3 and a $2 or whatever. I don't have the exact numbers, but basically I did the calculation on what was paying out this Friday from YieldMax, and the Robinhood one, it came out with a capital efficiency rating of 9.5%. So if I took my whole investment that I had in PLTY, which paid me $358 last week, and I roll that into HOOY today, I will get a $996 distribution on Friday. So that's basically how I am moving forward. I will look at the declarations, and whatever spare cash I have on the side, I'll be like, all right, how much is this one going to return immediately to me? And I will run those numbers, and I will throw it in whatever one will pay me the most immediately. And that's how I've been building my portfolio.
Is that the typical strategy, like the successful strategy amongst the passive income investors?
I'm not sure if it's unique to me. I've heard other people talking about something similar to that. I don't know if anyone else is doing it other than me. I don't know. I don't speak one-on-one with everybody. There's a select few on Blossom that I give a heads up, hey, I'm doing this week. What do you think about that? At the end of the day, I'm not influenced by any other investors anymore. I used to blindly follow people. I'd buy what whoever bought, or like when I first started, I bought every single holding in Perry's portfolio because I didn't know what the heck I was doing. He told me that I don't know how these are going to play out. Be careful. He gave me his rules that he follows for his portfolio. Obviously, I ignored most of that, but I developed my own thing. I was on a mission for the longest time to get paid every single trading day that the stock market is open. And I would research anything that was high yield. I would buy it. I would track when the declaration days, when the X days are, when the paydays are, and I would roll my distributions into whatever X day I can hit next. And I had a pay train that was almost every single day of the week. Eventually, I was stuck. I needed a Monday and a Wednesday. And then I did my transformation thing, and I filtered out all the ones that weren't returning enough capital to me fast enough. And now I'm rebuilding all that up again, more strategically than I did the first time.
Does it matter to get paid daily versus weekly or monthly? Are you concerned about that now?
I'm not as concerned about it now as I was. It was just fun for me just to try to get paid. And then it was too easy because it's all laid out in front of me. I didn't have to hunt for them anymore. So I did my capital efficiency formula, and I offloaded everything that I could that didn't return me more than 5% a month. I offloaded everything and fire sale everything. And then I consolidated my TFSA because I had freaking probably 65 US high yield something or others in there. I consolidated all of that, and then my RSP, I consolidated all of that into the original 4 I had, basically how I'm rolling now.
So as of right now, as of this Masters of the Market chat, are you able to break down your income for us, how much you're receiving per month, what that looks like annually, and how many positions? We don't need to go through each position because everybody out there, we all have to know that Jamie's entire portfolio is available to you transparently on Blossom. So if you're not already on Blossom, there's a link down there in the pinned comment description. You'll head over to Jamie's account and you can see the full breakdown. But just so we have a good understanding now, what are we working with on a monthly basis and on the annual basis?
I don't know if you'll be able to see it or not, but yeah, my portfolio is linked on Blossom. You can look at it. I'm completely transparent. I'm honest with all of my followers. If I lose everything tomorrow, I'll let everybody know. Like, guaranteed, I will let everybody know. I'm not trying to hide anything. I try not to spread misinformation. I try to correct people when they do. I try to be respectful in all communications with everybody. My TFSA, I don't know if you can you see it, or is it blurry?
There we go. We can see it. I can see it at least.
I'll read it off to you. I set myself a goal for $5,000 a month in my TFSA. I reached that target today, so I'm projected currently to make $5,337 a month now. And so far for the month, I am projected to receive $4,904.43. And Friday, I'm expected to get paid $1,481.96.
They're off the charts when I hear them. And before we even started recording, you were talking about your projected annual income. Can you give us that number?
The projected annual income in my Div tracker is currently at $64,091.34. And then I'll switch to my RRSP. I also have a non-registered margin account. My whole ULT position, I have it in that TFSA portfolio, so that's all combined in there. And that's also accounting for 15% withholding tax. And then I'll have to deal with the tax man at the end of the year for the rest of it.
Is dealing with the tax man for you?
I believe it is. Granted, we're also in a pretty bullish market right now, so it could all just be a coincidence. Basically, I got a personal loan from Fig Financial for $32,500, and I've already received over $1,000 of distributions from it, and the margin interest. So basically what I did, I took the Fig Financial loan, I bought the shares outright, so I own them, and then I linked my TFSA to my margin account so I can borrow against the holdings I've built up in there. So I feel more at ease that I'm not going to get margin called doing this. So then what I did is I took a margin loan and I paid the Fig Financial loan. So now I'm paying 4.95% interest, and the margin interest per month is $135 or $4 and something cents a day. And I figured even with paying, then that all depends on this staying the same the whole time. But even if I pay the taxman 50% of that distribution, I'm still coming out ahead $800 a month. So I pay the margin interest of $135. I pay the taxman the 15% withholding tax, and then another 35% tax on top of that. I'm still ahead $800, and it's a little bit on the degenerate side, but I feel pretty safe about it. The way I position myself into it, I feel pretty confident on it.
What's baffling to me, both baffling and inspiring, is the fact that you went from someone who was in a position of loads of debt to not too long thereafter starting your financial journey towards financial freedom, passive income, earning, and here you are today literally making in passive income what some people make as their salary on an annual basis. So I want to first ask you, when other people are out there listening to this now, first of all, I know that there's a lot of quote-unquote haters of this investment strategy. I first want to know what you would share with them. A lot of people would say, this strategy, Jamie, doesn't work. It's ridiculous. I know you personally have probably had those comments on Blossom and wherever else you've been speaking about this journey or this strategy. If you could speak to some of them, what would you share with them so they can perhaps see where you're coming from with this?
That's basically what turned me into Mongoose Financial was the toxicity between the different investing types. And I grew up, I was bullied all my elementary school year, all my high school year, and then eventually I decided that enough was enough. I'm going to stand up for myself, and I don't give a crap what anybody thinks of me anymore. You can think I'm a total piece of shit. Doesn't bother me. I don't lose any sleep over it. Basically, I have had some decent conversations with a few people on Blossom, and it's always maintained respectful. The simple definition of investing is put some money into an investment with the expectation of generating a return. Does it have to be the 500% that MicroStrategy went up? No. I need my cash now. I have credit card bills to pay. I have groceries I have to put in the fridge and on the table for my wife and my kids. I needed cash now. I didn't have the time for growth, so I leveraged what little financial assets I had left to gather the most amount of cash flow I could get with the least amount invested. And if it all went up in smoke, then that was my bad. There's many roads to the finish line. Some people can wait 40 years before they can realize their returns. Some people need their cash immediately. I don't even try to even call it passive income anymore because it's far from passive what I'm doing. It's very, very active. It's always researched. It's always calculating and figuring out which ones will return me money fastest. Basically, how I operate my portfolio is how these guys operate their ETFs. I have my primary objective is to deliver me the most amount of cash flow with the least amount of capital invested. I typically buy and hold. I don't trade in and out. I don't swing trade them. I don't dividend capture them. Whenever I make up my decision to buy something, I'll do my little capital efficiency formula, and I will basically throw as much money as I can at it. If it returns me all my capital in 10 or 11 months and I'm playing on house money, I haven't lost anything. Sure, I'm not going to get the total returns of if I invested in the underlying, but that's not what I need at this stage of life. I don't need it now. I'm completely debt free now. I've wiped out all the debt I've had. My credit score went from 631 to 831. I made a post about that a couple months ago. I don't need the cash flow right now, but this is fun for me. It's working. My time weighted return in my RSP is now plus 44%, and when I first started on Blossom, it was negative 18.9. So what I'm doing is obviously working for me. It's fun. I enjoy the passive income community. I set a dividend milestone in Div Tracker or stock events or Blossom. I make a couple reinvestments whenever my distributions come in. It's like, bam, 25,000, bam, 50,000, bam, 85,000, bam, 100,000. Like so it's obviously doing something. Like I've already received $52,000 since April last year, cash in hand. Now that all my debts are paid off, it's all being reinvested. I don't take anything out for daily needs anymore. I used to be a slave to my credit card. I used to be a slave to debt. And now debt is really not to be feared. It's to be respected. So now I'm using debt to my advantage to generate more cash flow for me, for more income to grow my portfolio. Yeah, I took a little bit of I wouldn't say gamble. It was like a calculated move to take that loan to buy those shares based on the trajectory of it. It's working out so far, and then doesn't work anymore. I'll have to decide to abandon ship or sell the shares and pay off that margin loan or roll it into a different fund that pays. It's all a big game, I guess. I kind of have an addictive personality. I got into like the Clash of Clans games and whatever that other one was.
Your story is incredibly powerful. And as you were speaking, something that came to mind for me is almost the strategy of, I want to say the 1%, right? They always use debt to their advantage. And that's always a big distinction. Even if you read it in the classic Robert Kiyosaki, Rich Dad, Poor Dad, right? It's use debt to your advantage. And many, many wealthy individuals speak about exactly what you just spoke about. You just shared something I think that was very powerful, which is debt is not to be feared. It's to be respected. Now, on the other end of that, there are so many investors who are very risk adverse. who I want to say a large amount of them probably never experienced, the volatility of life that you may have. But you're on the other end of this whole thing now with all of this experience. So how should people begin to reframe their perspective on debt?
Only use it if you absolutely have to. If you can pay cash for something, pay cash for something. I had an income problem. Like when we bought our house, we specifically bought below our means. So if I lost my job, my wife and her brother could carry the mortgage. Or if my wife's brother lost his job, my wife and me could carry the mortgage. Or if they both lost their job, I could carry the mortgage. I wasn't anticipating that the brother would move out and then I'd be short his stake in the payment. And then gradually, I'm a single income. She was denied mat leave. Eventually, groceries all went on a credit card. Fuel for the car all went on a credit card. Like I couldn't call in sick to work because if I don't get my paycheck, then at least that minimum on that credit card is not going to get paid. So I was in a desperate need to do something, and I chose this. It's working out. It's still working out. It's working out rather well. So I would advise that building credit is important. You need credit to get ahead in life. Just don't get carried away with it. Don't be reckless on the credit card. You have to pay that money back. Once you get so far deep into those credit cards, the system is designed that they're not going to let you out without a fight. You get a credit card statement that says time to pay off 135 years. That is not going to happen, buddy, no matter how hard you try. Keep that in mind.
Literally, yeah. I think as you shared it, Beth, before, a slave to whether it's, a credit card company, a slave to a company in and of itself, the means of how you're investing is truly how you can break free from it all. I want to ask you, Jamie, just looking back on your whole journey, I think this is honestly one of the most inspiring chats I've been able to have, just based on where you were to now where you are today. I'm blown away. But let's just look back at your journey for a second here. And there are probably a lot of investors out there, a lot of folks who might be in a similar position as you, and they don't even know what to do, like what their next step should be. And so what would you share with those individuals?
Oh, that's tough. That all depends on their individual risk tolerance. Me, like I was on the verge of losing everything. I was fortunate enough to get that $15,000 inheritance from the passing of my grandmother through my aunt. I was given that opportunity, and normally how I was brought up is debt is bad. You want to just wipe out the debt, but I had an income problem, so I'm like, all right, let's just make more income. So I went the income route. So it all depends on their risk tolerance. You want to find stuff that's not going to go anywhere. I know like Tesla is one of the most volatile stocks on the market. One tweet, it can go up or down or sideways, or one hand gesture, it go down, 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 down. You gotta know if you have the balls to freaking stick with it. Ride or die. Like I buy these things, every single one I bought, I will hold it till I lose every single penny just to make sure I get my money back. I'm stubborn like that. Like I just recently read about the Chinese zodiac animals, and it turns out I'm an ox, and I am so stubborn. When I make my mind up I'm going to do something, I am going to do it. Like we have little competitions on Blossom. You've probably seen me chime in on a couple people's posts. Christopher John, P. Sunny, dividend gathering expeditions. I'm like, race you to 5,000. You want to race to 5,000 a month? Let's go. There's just no selling kidneys. You can sell feed picks, but you can't sell kidneys. So we raced to. I kind of cheated a bit by doing my margin account, but it's all in good fun.
What I gathered from that is step one, every investor needs to understand their Chinese animal sign of who they are as an investor for their investor profile. And step two, again, download Blossom, because what's just crazy to me, and I'm always talking about this video to video on the other podcasts I run, but you have to have a strong community around you, even just for something as simple as what you just said, where you have these competitions who can get to $5,000 a month, in income, which is just it's something I think we haven't had before, at least to the extent that we have it today. So, how much of a role, and I know it was really pivotal for you in your journey, but how much of a role do you think Blossom or an investment community really played and continues to play on your journey?
Paramount in me making this decision. If I hadn't have found Blossom, I probably would have ended up riding out my mortgage refinance and then having to make the decision, do I take a cash out refinance and pay off all this debt and roll it into my mortgage and turn all this unsecured debt into secured debt, buy my home? I didn't really want to do that. So the community of Blossom inspired me, and the hatred towards passive income investing made me want to do it more. Telling me you can't do that you're going to lose everything, those funds are trash. I was like, buddy, just call me the trash collector. Like, come on, I'm going to get as many of these things as I can. That's also what wealthy people have in common. They're not one-trick ponies. They have multiple streams of income. Multiple. Look at Donald Trump, like Donald Trump Media Technologies. He's got the freaking casinos. Like, granted, maybe he didn't manage them all that well, but Elon Musk with Starlink, Tesla, all his businesses, the Boring Company, multiple streams of income. X, Grok. The way I looked at it in the beginning, it is easier to get $1 from 1,000 people than $1,000 from one person. My original objective was to get as many of these ETFs as I could find to pay me $100 a month. I started accumulating them, and then whatever X day showed up next, I would roll into that one. I'd roll into the next 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 one. I'm like, oh, this one's paying me $100 a month. Okay, I'll skip that one. So roll into the next one, rolling until I was making, I think at the peak back then, I got to $4,300 a month around November, December of last year. And then the mortgage refi came out in March. And my mortgage broker said, hey, buddy, you got 11 trade lines open. You got to close some of those. So I basically liquidated my TFSA, and I paid off all the debt I had to. I was like, well, that was a good run. I don't know if it was luck. I don't know if it was skill. I don't know if it's just coincidence. But that worked out. So I'm like, well, now all my debts are paid. Let's see if this is repeatable. So I started it all over again. It's repeating so far. Liberation Day, that was definitely scary. I had around, I think, a $97,000, $98,000 portfolio at the time. And as soon as the talks of tariffs and whatever happened, and this and that and the other thing, my portfolio dropped like 25K in like 2 weeks. I was like, whoa. And I was in a moment of like indecision. There's comments threads on Blossom about, bet you wish you didn't pick those things now. Not specifically directed at me, but passive income investors in general. And I'm like, oh boy, maybe I shouldn't have picked these things. But I looked at it as a gift. Entry point is key when you're investing in these sort of things. The lower you can buy them at, and if they're companies like Tesla that freaking swing up and down 10% on whatever tweet or whatever stuff, I'm like, it'll come back. I personally don't see Tesla going anywhere anytime soon. I just stuck to my guns, and when the market goes bad, I put more money in. I don't panic. I don't pull any money out. I'm like, oh my God, what am I going to do? Whatever I have that's spare money, if it's something that I want to keep accumulating, I will throw whatever I have into it to get it at that price. And then when it appreciates in value, then I can trim some gains and roll it into a new position, or roll it into a position I'm really down on if I want to exit it to try to get myself to a total return acceptable level. Like, obviously, some of them play out, some of them don't. Like, you need some real fortitude to stick to the freaking plan if you decide to go down these highly volatile, high yield ETFs. If you want to come out ahead, you have to be pretty stubborn.
Can it be developed, do you think, or is it just innately in somebody to have that much fortitude?
I'm not really sure, to be honest with you. I think you pretty much have to be born with it. I see other income investors on Blossom that I'm envious of their portfolios, and I'm trying to achieve what they have in a roundabout way. Like, they've worked their whole adult careers working, and they've rolled their growth portfolio into an income portfolio at the end of their years. And I'm starting at an extreme cash flow portfolio. Well, I'm 39 years old, so I'm not terribly young, but I'm not old either. I still have a lot of working years left. I didn't really take investing seriously until a couple years ago. I started investing when I was really young. I started off with share certificates, if you can believe that. And I've got one here. Let's hide my address on it, but it's for Pfizer.
Wow.
I started off with share certificates when I was 17 years old.
Man, you got to get that framed.
Yeah, so basically, yeah, that's how I started. I forget what book it was, but they was talking about drip investing. I know how compound interest works. Like, I forget all what I bought. I bought Johnson & Johnson, I bought Pfizer, I bought Suncor, I bought Riocan, Bank of Montreal, Royal Bank, all paper share certificates. And for the life of me, I couldn't find any of the older ones. And I have them filed away somewhere here. I signed them all up for drip plan, and I logged into my computer share account a couple months ago. They're all up like 200%. But I invested in these like 25 years ago. It took that long, but it compounded. My, I don't know, $25 in Suncor in share price alone, it's already like 50 something now. And now I have almost 2 shares of it just because it dripped that 50-cent dividend every quarter for 20 years. So compound interest works. The way I'm doing it now is I'm compounding it almost daily. And every time I get a distribution, like, I have no cash on the side. Every time I get a distribution, I'm like, what do I roll it into next? It's just little fun things like that. Try to buy something with some aspect of growth to it, a little bit of stability. Play around, find something that works, stick to it.
Jamie, let me ask you this. For the younger viewers who are out there, should they be getting on this income investing train?
It all depends what your end goal. Personally, I don't think it's a terrible idea to allocate a small portion of your portfolio to some cash flow generating securities. I don't think that's a terrible idea at all. It all depends on the individual investor's growth or risk tolerance and what their ultimate goal is. Like, everybody asks me for advice on this sort of thing. I don't advocate for anybody to do what I did. It's insanity to have pretty much 100% of your portfolio in these things. Like, I don't know how long it'll last. I get teased about it. I say I don't have a crystal ball. I'm strategically yield chasing. It's like, how can you strategically yield chase? I do my capital efficiency calculation, and if it returns 10% a month, in 10 months, I'm whole. So it's just got to last 10 months. Sometimes it does, sometimes it doesn't.
Jamie, one last question for you here. I want to wrap up on just an extremely positive note. What would be some words of wisdom or words of advice that you could share, generally speaking, to the massive investors so we can all get to the rabid mongoose financial position of being financially free, so to speak, or at least in a much better financial position than when we started this video?
Basically, my words of wisdom would be to get educated, learn about the products you want to invest in, find a strategy that works for you, ignore all the noise. There are going to be people that are absolutely against these type of investments, no matter what you say, whether you can prove you're making money or not. Just find what works for you. Research as much as you can about it and make your decision. Like if you want to try product, just try it. You can go to a bar and waste $100 and you don't get anything out of it, and you can start generating cash flow. Like that $100 you would have wasted at the bar is doing something for you. So don't be scared to try it. But what really bothers me is people that hate on these type of products that have never owned them or would never own them are telling you what you should do with your money. You are the only one that knows what's best for you. So you just have to figure out what it is and do it.
Strong words of wisdom. And to all the investors who are out there, if you really want to see what a true ox portfolio looks like, you can head over again to Blossom and find Jamie's entire portfolio, everything that he's invested in, how much is there, how much he's receiving in dividends. I mean, it can't get more transparent than that on Blossom. Jamie, I want to thank you personally for jumping on with me and all of us on Masters of the Market to share your story. Powerful, powerful power. And investors, until the next go round of Masters of the Market, we will catch you all in the next one.